Hello, my name is Jeffrey Kennedy and welcome back to another episode of Elliott Wave Junctures. The wave principle is divided into two categories, or two wave modalities, one being motive waves, the other being corrective waves. With motive waves, we have two types. There are impulse waves and ending diagonals. Corrective waves, you have three types, zigzags, flats, and triangles. Today we're going to look at one of the two types of motive waves, and that is the ending diagonal. The ending diagonal is a wedge-shaped pattern. It's a five-wave structure where in each wave of that pattern it subdivides into three smaller waves. In other words, what you have essentially is a five-wave move where wave 4 ends in the price territory of wave 1. It has a distinct wedge shape to it, either a rising wedge or a falling wedge. In each move, each wave within the structure subdivides into three smaller waves, and those waves are labeled A, B, C. Now, it's an ending pattern or terminating pattern that can only form in the fifth wave position of impulse waves or the wave C position of ABC formations. In this price chart here, working down from this extreme, and this is Union Pacific, what we actually have here is waves 1, 2, 3, 4, and then this would be an ending diagonal in the fifth wave position. Now, what is exciting about this pattern is whenever they're complete, whenever they're finished, they tend to introduce very swift, sharp, volatile moves back to beyond the origin of the pattern, just as you see here. Now, we also have another example in this issue. This is Packer, ticker symbol PCAR, and again, this is a fifth wave. This is an ending diagonal in the fifth wave position. And that specifically, this would be waves A, B, and then we have waves 1, 2, 3, 4, and then we have our ending diagonal. Again, it's a five-wave move where wave 4 ends in the price territory of wave 1, and there's a distinct shape to it, a distinct rising wedge, either rising wedge or falling wedge. Now, the final price chart I want to show you is that of Google. Okay, here's a long-term price chart of Google, which goes back well into 2011, actually about June, July of 2011 to current times. Okay, now the pattern I see here is this. This is what I believe to be an ending diagonal in this market. Now, one thing that's very important, again, with ending diagonals is whenever they're complete, they tend to lead to very sharp reversals in price back to beyond the origin of the pattern. That would be actually, in this instance here, a little bit below, say, 475. Now, also, too, what I like about this structure, number one, it's actually a truncation. Okay, it includes a truncated wave. And what I mean by that is typically what we see with an ending diagonal and with all impulse waves is that wave 5 terminates beyond the extreme of wave 3. In this instance, it did not. So it is referred to as either a truncated wave or a failed wave. The reason I keep my eyes out for truncated waves or failed waves, which are rare, they only form about, say, 10, maybe 15% of the time, is that it signals to me hidden or underlying, in this instance, selling pressure. Now let's look what happened since that 2-4 trend line gave way. Now, this is the 2-4 trend line that I'm referring to. And again, this is where we come up with that rising wedge in this instance shape, where you simply connect a trend line from the extremes of waves 1 and 3 and 2 and 4. Now, if we look a little bit closer here at the subsequent price action, here was our 2-4 trend line break right here. And we've also since penetrated the extreme of wave 4 as well. Typically, that's one of the key levels I look for with respect to ending diagonals. Now, what we have actually seen transpire in this issue since the actual formation or the completion of the pattern back in earlier in the year in 2012, we've seen an impulsive decline followed by a clear three-wave move up, and this would simply be waves A, B, and C. We've seen another impulsive decline, and again, another three-wave advance. Three-wave price moves are very significant to an Elliottician simply because most counter-trend or corrective wave patterns only consist of three waves. So what we potentially have here in Google, I think, is a 1-2-1-2 to the downside, which would actually argue for a very sharp sell-off to the downside here in wave 3 of 3, which coincides very nicely with the overall personality of the ending diagonal, which is a swift, sharp reversal in price back to beyond the origin of the pattern. Ideally, what we'll see in the next few trading days or the next week or so is prices to fall below the extreme of the second wave 1 right here, at which point we can actually identify this extreme here as critical resistance and look for prices to continue to sell lower back to below the origin of the pattern, which is a little bit below 475. And isn't it interesting that that's where where wave 3 will equal a 1.618 multiple of wave 1 at 468.47. Again, just a nice observation here. Keep your eye on Google. If the larger pattern identification is indeed correct, we probably have about another $100 to the downside in this stock, maybe a bit more, possibly about 150. Thank you very much and have a great day.